Let's begin with you, Tom. I call you the big Wall Street bear, so we should probably just get it out of the way with, shall we?
Growl like a bear.
Do you feel like the big bear on the street right now? Do you just feel very, very vindicated by what you see in the earnings? Is that good enough? Because they look pretty solid.
Well, you know, bear is definitely a relative term, right? Because we're not necessarily saying the market's going to be down 20%. But I think it's been difficult for investors to argue that this rise in the markets this year is purely driven by earnings. You know, median earnings are up about 8 or 9%. So the index lift that we're seeing is because of this mean reversion of turn in energy in the materials sector and the banks. And of course, year to date, those sectors aren't outperforming the market. So I think we've got a disconnect where I think multiples have really risen. And that's, you know, it's not necessarily wrong, but now median PE is at close to 19 times. There's only been, I think, 4 quarters in the last 40 years where it's actually been higher.
I mean, the pack, David Kelly, are looking for the S&P 500 year-end to be pretty much where we are right here, right now. So it is relative, the fact that you have got a call of 2275. Where do you sit on the big S&P 500 debate now?
Well, I hate making short-term call. I always hate making short-term call. But I agree with Tom that valuations are looking rich. The issue is what else are people going to do with their money, and how fast does that sort of expensiveness of the market feed through? And what we're seeing here is, you know, the big news today, I think, is around global central banks gradually pushing up rates with yields so low around the world. You know, the expected 5-year return on high-quality bonds is very low single digits. And in that environment, and with so much liquidity still unallocated in the world, I think that can still feed the beast a bit. What people need to, I think the right way to think about this is not in terms of can I time the correction, but what's my long-term return? And as we look at it, you know, if PE ratios are, say, 10% above average levels, if 5 years from now you get it to average levels, if earnings growth slows down to about 5%, you're still only talking about 5% total return on equities over the next 5 years. And that's not great. And so I think this is a time when people really need to think about how can I add some alpha to what's getting to be a more and more miserable expected return.